Good morning, I'm James Lopez, President at HomeFi Corporation, and this is today's mortgage and real estate market update. Now, big news this week has been the Fed meeting and the Fed press conference yesterday, and I want to talk about that for a few minutes, and I want to make sure that you understand what the Fed does and how it affects the markets, and really how it affects not just mortgage but real estate. So it doesn't matter if you're in the real estate industry or if you're in the mortgage industry. What the Fed is doing is going to affect both industries pretty heavily. According to National Association of Realtors, 87% of home buyers purchase their home with financing. That's a stat from last year. That's almost 9 in 10 transactions are purchasing with financing. So what happens in the mortgage market and with mortgage interest rates, that directly affects what's going on with real estate. So let's dive into it. Let's talk about it. Yesterday, Fed wrapped up their meeting, and everything that the Fed announced from their meeting was mostly in line with what was expected. So the markets reacted pretty favorably to that. There were two things that happened. Number one, the Fed increased their Fed fund rate, the overnight rate, and then number two, they announced the level at which they're going to start reducing their balance sheet. Okay, so let's talk real quick about what the bond market is. The bond is an open market. Supply and demand forces are what create and generate prices and price increases and price decreases and things like that. So that's the bond market's just a standard normal open market. All right, now mortgage bonds specifically, the yields for mortgage bonds are derived from their underlying securities, which are mortgages. All right, so the interest rate on the mortgage, once the bunch of mortgages get pooled together is the term, all right, and then they get bundled up into a mortgage-backed security. That's basically what a mortgage bond is. So as they get pooled up, the yield on that mortgage-backed security, that mortgage bond, the yield is derived from the underlying securities or the mortgages that are in that particular bond. So you've got mortgage-backed securities that are based on the note rates on mortgages, all right, and being traded in an open market that is subject to all of the forces of supply and demand. That's the big picture on how the bond market, and specifically MBS, works. Now, the two actions that were taken by the Fed, both of these actions specifically are intended to do one thing: slow down inflation. You slow down inflation by slowing down the amount of excess cash in the economy, and essentially slowing down the economy is how the Fed is approaching their path to slow down inflation. The first action that they took, they're increasing the Fed fund rate. The Fed fund rate is an overnight rate that banks use to lend to one another. This rate affects a lot of different things in the market. A lot of times credit cards and auto loans are based on this rate loosely. All right, so there's a bunch of different things that are affected by the Fed fund rate, but not so much mortgages, and here's why. Inflation is the enemy of bonds, period, right? So the higher inflation is, the less value a yield has from a bond or from a treasury. So by raising the Fed fund rate, their action is intended to directly combat inflation. That's good for mortgage bonds. So we should see, and we do expect to see, mortgage bonds to react favorably to that, okay? That basically, by increasing the value of the yield, you're going to increase demand for the bond, and that therefore increases the price for the bond. The other action that they took is more specifically asset reduction on their balance sheet. Now, this is the one piece that we weren't sure how exactly they were going to approach it, so this is what they announced. They're going to reduce their balance sheet by $47.5 billion every month starting June 1st through August. So in June, July, and August, they're going to reduce their balance sheet by $47.5 billion. Each month, they're going to reduce their balance sheet for U.S. treasuries by $30 billion and mortgage-backed securities by $17.5 billion. Now, here's what that action is going to do in the bond market. It's going to lower demand in the bond market, right? There'll be less demand, they'll be purchasing less, which means there'll be less demand in the bond market. So as the demand goes down, the price goes down, right? So the one action, raising the Fed fund rate, makes and combating inflation, makes the bonds more attractive, so it creates more demand for the bond. The other action, removes a buyer basically from the open market in essence, and so it creates less demand for the bond. So both of these actions have conflicting effects on the mortgage bond. So what that means for mortgage interest rates specifically is that, you know, the like I said, the bond is basically the yield is derived from the interest rate. So as the price of mortgage bonds go down, in order to create more demand in the bond market, banks raise their interest rates on the mortgages that they originate. All right, so the higher interest rate, you have higher yields on the bonds. Demand, because the bonds have higher yield, demand goes up, price goes up for the mortgage bond, and then it starts to level off, and it becomes a cycle, right? It becomes cyclical. So you know, then maybe a bank will say, hey, we want to get more consumers, we want to originate some more loans, so they'll lower their interest rate, and then the other banks start to follow, and you see the mortgage bond start to go down because the yield goes down and demand goes down, and then you go back into the other side of it. You know, they raise the interest rates and so on and so forth. So that's kind of, you know, how the mortgage bond really affects interest rates in the market, and that's how, you know, what the Fed is doing is affecting the mortgage bond. So let's tie that back into yesterday and today. The reaction yesterday from the mortgage bond market and the bond market in general was favorable. They liked what the Fed did, and so we saw a pretty sharp increase, about 70 basis points. The mortgage bond specifically went up about 70 basis points. All right, so today the mortgage bond is down about 52 basis points. We've lost some of those gains, and then today the 10-year yield is up about 14 basis points. What this means for mortgage rates is that mortgage rates are going to open probably about where they opened yesterday. We did see a reprice for the better during the day as we saw mortgage bonds, you know, sharply go up. So we did get some repricing for the better, but because most of those gains were lost today so far, we're probably going to see mortgage rates open up about the same as they were yesterday. You know, then the reason why, actually, one of the reasons why one of the market movers today for the bond market is part of that supply and demand thing. So we've got steady demand, but there was a corporate bond issuance. Some of the corporate bond issuance was expected, some of it was not expected, or at least the sizes weren't expected. So all of a sudden in the bond market, you have more supply for investors to purchase in the bond market, and so you're going to see prices drop on the mortgage bond and other bonds and treasuries. So again, that supply and demand happening in the bond market. It's a little bit of chaos, just like in any market. Little changes can make big differences, but that's what's going on today. So again, mortgage rates are probably going to open up about where they were yesterday. So we'll say flat between the 2 days, and that's the news today, and that's how the Fed and what they're doing is affecting mortgage bonds, affecting interest rates, and ultimately affecting the real estate market. Listen, there's a lot to unpack in there. I understand that. If you have any questions about it, please feel free to leave a comment, shoot me an email. My email is james@homefi.us. Shoot me an email, leave a comment, subscribe to our YouTube channel. Would love to have a discussion about this further with anybody that wants to. I hope you have a wonderful day today, and we will see you tomorrow.